When you hear people talk about dividend investing online or on CNBC or some other platform, you'll notice they're usually referring specifically to dividend growth investing. This is the strategy of buying very low yielding stocks, typically offering yields of less than 1% to 2 or 3%, and hoping over a long period of time that these stocks will grow in share price and dividend distributions. This was the original way people pursued dividend investing many decades ago, and most resources available on dividend investing still only cater to this strategy. For this way of investing, it's all about the long-term game, staying committed and investing for many years to see your income grow. However, in recent years, a new form of dividend investing has been gaining a lot in popularity. Fund managers have realized that investors who aren't even necessarily retired yet want higher yielding investments available to them. More and more people started wanting higher dividends now without having to wait decades for companies to try and grow theirs over time. This led to the creation of income investing, also known as high-yield investing. People who are more motivated to invest in high income-paying stocks and funds often receive criticism from dividend growth investors. Although income investing does have its downsides, there are also downsides to dividend growth investing that I never see anybody talk about. The media likes to put dividend growth investors on a pedestal for their ability to wait decades before their dividend payments become something meaningful. So today I want to focus on 3 negatives that come from pursuing dividend growth investing over high income investing. Before getting started, it does need to be said that both investing styles will lead to prosperity. Whether you're pursuing dividend growth investing or high income investing, both will result in a better financial future for you as long as you're picking good investments. Not a lot of high-risk positions or a lot of speculative companies. If you're doing this and doing it consistently, then you can expect to have a lot more money in the future. One investing style isn't necessarily wrong compared to the other, but there are some major downsides, again, that exist with dividend growth investing that people rarely talk about, which we'll now look into. Problem number 1. If it's your goal to solely live off dividend payments, unless you're very wealthy, an early retirement is going to be out of the question. If you look at any dividend growth investment, one that's been dependable for many decades, what you'll find is they offer very low yields. As mentioned in the beginning of this video, it's normal for these companies to offer yields of 1% or 2%. This means that in order to make $60,000 per year in dividends, you need to invest $6 million today in a 1% yielding stock or $3 million in a 2% yielding stock. Whereas if you invest in an income investment yielding 12%, you would only need $500,000 today to earn $60,000 per year in distributions. Okay, so maybe you don't have a few $1,000,000 or even $500,000 to invest today. That's very likely going to be the case for the majority of people watching. But what about that dividend growth? If a stock is growing their dividend every year, as opposed to a 12% yielding investment that doesn't offer any dividend growth, surely that means over the decades, the dividend growth investment is going to be the better choice because that should result in better compounding, right? Well, we can test this ourselves by using a dividend reinvestment calculator. There are a few out there that exist, but for this example, we're going to use the one from MarketBeat's website. Let's compare the annual dividend income of 2 investments, a dividend growth holding and an income holding, over the course of 20 years. For our dividend growth pick, we'll go with Church & Dwight, ticker CHD. This company produces laundry detergent, baking soda, and pregnancy tests, very solid products that aren't going away anytime soon. Did you know this stock has paid dividends every year since 1901? That's 124 years of dependable income, which sounds like a great pick for a dividend growth investment. I'm going to plug in all of the information into this calculator using the data from seekingalpha.com. We'll start off by assuming that you have $500 to invest in this company. $500 divided by $98.05, which is CHD's current share price, is 5.09 shares. We'll go ahead and round this up to 6. Initial annual dividend yield is 1.2% and it pays quarterly. We'll assume you're investing $500 a month into this holding, which is $6,000 per year for the next 20 years. Now ideally, you wouldn't want to put all of your eggs in one basket, but for the sake of keeping things simple, we'll just assume that's what you're doing here. The expected annual dividend increase is 4.36% according to Seeking Alpha's information. We'll have it drip, meaning the dividends will be reinvested each quarter. For this example, we'll also leave taxes out because they differ depending on each person's location and what kind of investment account you're using. CHD has grown 19.38% in share price over the past 5 years, which is 3.86% per year on average, but we'll set it to 4% per year. When we hit calculate returns, we can see that after 20 years of consistently investing into this growth stock, you'd be left with an average yearly income amount of $2,655.88. This would leave you with an ending account balance of $205,550.70. Definitely not enough to retire off of, even if you were selling shares. But now let's do the exact same test, only with an income holding. For this, we're going to go with SPYI, which is an S&P 500 covered call fund. Again, we'll use this information from Seeking Alpha. SPYI is currently trading for $50.78. A $500 investment divided by $50.78 is 9.84 shares, so again, we're going to round this number up to 10. Annual dividend yield is 12.1% and it pays monthly distributions. Now, for expected annual dividend amount increase, we're going to go with 0. This ETF has provided a little bit of growth, but nowhere near as much as Church & Dwight. But for our test, we're going to go with 0. We'll also set expected annual share price growth to 0 as well, despite there being growth here too. Annual contribution and years invested will be the same, just like before. And we'll also keep it dripping every month. When we hit calculate dividends, we can see a much better outcome with the high-yielding investment. So much better that it's not even close. Annual dividend income is $61,384.16, and even the total capital is much higher at $479,784.11. This shows that you can live off dividends with a much smaller amount invested compared to a dividend growth stock. 20 years of investing $6,000 per year is only $120,000. That's not a lot of money considering the outcome, and we can see we barely made it very far with the dividend growth option. Say what you want about taxes if you choose to do this in a non-retirement account. Would you rather earn $2,600 per year worth of tax-free income or $61,000 per year, but you do have to pay some taxes on it? Sounds like it's worth it to me. I was going to move on to the next point here, but these results were so ridiculous I wanted to replace Church & Dwight with something else. Something that'll hopefully get us closer to the income holdings results. Let's pick a different dividend growth stock with a higher yield and much more dividend growth. We're going to go with the Home Depot, ticker symbol HD. Everything is going to be the exact same here. The same $500 investment, well, a little more because it's currently trading at $370.11 per share, so I'm going to round things up to 2 shares initially. The same 20-year period, the same amount invested each year, quarterly dividends, and so on. But this growth stock has twice the dividend growth and a current yield that's twice as high as Church & Dwight. When we hit calculate on the calculator, again, it's nowhere near as close as the income holding. And the Home Depot has only been increasing their dividends for the last 15 years, so it hasn't been as consistent as Church & Dwight. Problem number 2, having to sell shares is much more likely with the dividend growth route. Continuing off our previous example, if you did go the dividend growth route and you weren't able to save a significant amount of money in your working life, then you face a threat. Let's assume after all of your decades of investing, you might be earning $20,000 per year in dividends. Now that's still good. That's income that's completely passive that you don't have to lift a finger to earn. But even with Social Security, that's not likely to be a great amount in retirement. Because you're earning less than what you would have if you held income investments, that could mean it's likely that you might have to sell shares of your dividend investments to cover surprise expenses. Once you start having to sell shares, it could cause a domino effect. Selling shares of your dividend positions will mean you're earning less income going forward from your holdings. If you're earning less, that'll increase the odds you'll need to keep selling shares to cover your expenses. You don't want to have to worry about depleting all of your investment capital during retirement. Income investments can provide you with much higher dividend payments that'll give you more money to cover your expenses. If you're making $60,000 per year off of income investing instead of $20,000 per year with dividend growth investing, that's obviously a much better position to be in. Finally, problem number 3. Dividend growth investing is very hard. I'm not saying picking good investments is hard, but as we all know, especially if you're not rich, is that sticking with dividend growth investing is very hard. The majority of people who pursue this investing style will quit early because it just takes too long to see the compounding go into effect. The dividend snowball is the greatest part of being a dividend investor, no matter if you're pursuing growth or high income. Allowing your dividends to reinvest over a long period of time multiplies your dividend payments as time goes on. But as we saw with the income holding earlier, high-yielding investments started seeing significant compounding much earlier than the growth stock. As more time goes on, the Home Depot will eventually overtake SPY. But Home Depot has only been growing their dividend for the last 15 years. Do you really want to bet that in 30 or 40 years, which is how long it would take for the dividends to outgrow SPY's, that they'll never have to cut their dividend again? That's a major bet that I personally don't want to take. So what would be my suggestion then? If you're solely a dividend growth investor, I'm not going to suggest that you should completely switch to income investing. I always advocate for investing however you feel most comfortable. But considering some high-income holdings for your dividend portfolio would be a good idea. It can boost your income significantly, and it's a lot more motivating than collecting $50 in dividends your first year, $65 in your second year, $91 in your third, and so on. But feel free to let me know your thoughts and why you pick dividend growth investing or income investing, or maybe a blend between the two. This channel focuses on both strategies, but primarily caters to income investments, so feel free to check out some of the other content on this channel. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.